Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, great article in Realtor.com. Here's the title. We're going to jump right into it. Is the fall housing market really going nowhere fast? What buyers and sellers need to know.
Right. So stay tuned for absolutely brilliant things from Realtor.com.
Brilliant things. I thought that what really caught my eye about the title was what buyers and sellers need to know.
Right. And that was the point, right? Because they're being clickbaity.
They're being clickbaity. Okay. We have this outstanding chart that is going to show the tone of how things have changed this year and the expectations of what home prices we're going to do, and now with the expectation of home prices, how they've changed substantially, okay, over the last year. Okay, here is the first quote from the article. The housing market is stuck and isn't likely to unstick itself this fall. What does that mean? It's stuck. How's it stuck?
Well, so to put it bluntly, there's no inventory, there's no movement. Everybody's kind of hunkered down and not going anywhere. Sellers aren't selling, which means buyers have nothing to buy.
Okay, so there's sales happening still, but for the number of amount of inventory, there's still a relatively robust number of people buying.
Right.
As few homes are on the market.
Right. So here's the thing. The number of transactions that we should be having is down, not the amount of money being spent, but the number of transactions. And that's what this is about.
Okay, here's the first quote. The housing market is weak and is going nowhere fast, says Mark Zandi, chief economist at Moody's Analytics. I don't think it's going to get any better, but I don't think it's going to get any worse because it can't get any worse. So when he says get any worse, what's he specifically talking about?
He's talking about the low inventory. So first of all,
low number of sales.
Right.
Yeah.
So, so I kind of take issue with things can't get any worse, because every time any of us say that in the real world, what happens? Things get worse, right?
Yeah, they get worse.
So that was kind of funny that he said that.
If things get bad, I'm going to blame him.
There you go. And then, his whole thing of that, that things are really bad and that sort of thing. Well, they're not bad. Housing is really stable, okay? That's kind of the bottom line of this. It's really stable. There are not a lot of transactions. There are still people buying. There are still people selling. But that the number of transactions is what he's talking about. Okay.
Here's another quote. Mortgage rates averaged 7.12% for 30-year fixed-rate loans in the week ending September 7th. According to Freddie Mac, that's up from 5.89% a year ago and 2.88% 2 years earlier. 7.12% is the median 30-year fix for an average buyer. It's based on Freddie Mac. There are other websites you can go to that will show different numbers, but that's just, they're just random numbers. They're not actually what you can go get a loan for today.
Right. And remember, everybody's loan is actually a little bit different, right? Because it's based on your credit score, your credit history, the age of your credit, your down payment, your debt to income ratio, just, all these things. So, you and I could go to the same lender at the same time, apply for the same loan, and we would get a different interest rate. So they're just using a number that is kind of, by and large, this is what the going rate is.
Yeah, that's sort of but 7.12% right now is the 30-year average 30-year fix. Right. Okay, now here's a couple of pieces from the article. What I thought it was interesting was the different people have different changes in their in what they think is happening. Okay, here's the first quote. It's not all bleak. Okay, there were slightly more homes that made their way onto Realtor.com in August. New home sales have been strong. Plus, there's historically less competition for homes in the fall. Families with children in school have generally already moved, and many renters have renewed their leases. In Vegas, somebody had made a comment about all the empty houses in Vegas. We really don't have any. Now, didn't you just put a tenant in a rental, right?
Right.
For a property management client. Didn't you just tell me that, or didn't I hear you say that you had like 100 different people called you on the property?
More than that.
So
yeah,
it's not like there's a bunch of houses sitting around that nobody wants. Like a rental comes on the market here in Vegas and it pretty much is like a hot potato.
Well, so there are a lot of people interested, right? The issue is that that intersection between people who are interested and people who are qualified.
Right. Yeah.
So that's really the big thing. Is we are very particular about the people that we place in rentals that we manage because we have to deal with these people day in and day out going forward. So we want to make sure that these people are well qualified and we're not going to run into issues down the road. So we have pretty much very similar standards to mortgage mortgage loans, in the sense of, we want a certain credit score, we want longevity on the job, we want, all these things. So that usually indicates somebody who's responsible and who's going to be stable and going to take good care of the property.
But then these people obviously have reasons to not buy for whatever reason, usually.
Right. So, look, buying isn't the right thing for everybody, right?
Yeah, of course.
Sometimes people don't buy because they don't have enough down payment. Sometimes people don't buy because they're new to the area. Sometimes people don't buy because they just sold and they maybe are expecting some life change and they don't want to buy. Whatever's going on in their lives, people have their own particular reasons.
Yeah. Here's another quote. The good news for buyers is once the Fed finishes its main inflation fighting initiative, mortgage rates could dip. And if the economy falters and falls into a recession due to rate hikes, the Fed is likely to cut the rates it raised. So there's two scenarios, and either one that happens is good for housing because we're already through the worst of it. Prices moderated, sort of like we said they did. And then, so either the Fed is done and rates don't go up anymore, right? Or we go into some kind of recession, the Fed starts dropping rates, and then mortgage rates obviously follow.
Right. I thought it was interesting that they automatically said, "Oh, there's a recession. It's because the Fed participate in raising interest rates." And I'm like, well, recessions are a little more complicated than that. I just thought it was kind of interesting that they just went straight to that and said, "Oh, this is the only reason why we would have a recession," which is not true.
Okay. The Fed board is going to meet, I think, next week.
Yes.
And then right now the consensus is no raise and then maybe another 1.25%. But pretty much they think they're done. That's what the Fed governors are saying. But here's another quote. For now, the Fed is expected to hold rates steady or even raise them again. Even if it does, mortgage rates aren't expected to shoot up wildly or hit double digits. And then it said, we're probably near peak mortgage rates now, said Dietz. Because remember, last year, this time, we got up above 7 for a bit, and then they went down to like 5.9 something 2 months later. And then they've been in the 6s most of this year.
Right.
So what do you think about that? We're near peak mortgage rates. How does this look? Because my contention has always been people are sitting on the sidelines with all this cash, and they're waiting for something to happen.
Yep, they're waiting for Godot. They're actually probably just waiting for the right property to come on the market, to be honest with you. I think that the limited inventory is the reason why people with cash have not purchased. It's not that they don't want to. It's that the right property, whatever that is for them, has not come on the market.
Okay, here's a price estimate. Moody's Zandy expects to see some price declines this fall, but not by much, which happens every fall. Prices go down, right? He expects prices to dip by a few percentage points by this time next year. Nothing like was seen during the Great Recession where prices dropped 30%. Certainly no 40 or 50% housing crash that has been predicted. It still hasn't happened. They've been talking about it for 4 years now. 2019 is when the crash video started coming out.
Right.
Well,
Well,
it did crash. It crashed up. Maybe that's what they meant. When they said crash 40%, they mean home prices would go up 40%.
maybe that's what they meant.
Okay, here's the next one. Hale, this is a different economist, expects prices to move largely sideways, staying about where they are now.
So I think that there's a lot of support for that thought because interest rates are what they are, and because sellers aren't really selling, and as far as buyers are willing to buy when the right product comes along, and the idea that interest rates are too high and prices are too high for buyers to buy is a false premise. It would be true if we had an abundance of inventory, but we do not. With the limited inventory we have, there are more than enough buyers to absorb what we have if it's the right product.
Yeah, I think so. Okay, here's next quote. The price increases should be pretty moderate compared to what they've done over the last few years, says Molly Bozel, principal economist at Real Estate Data from CoreLogic. But those high mortgage rates mean buyers' monthly payments will be pretty high. So we got one person said, oh, they're going to drop a couple percentage. One person said, hey, they're going to stay the same. And then this person is saying, oh, no, they're going to be pretty moderate price increases.
Right. I think in a lot of markets that there will be moderate price increases. There will be some markets that will decline, and there will be some markets that are going to be pretty flat, which is generally what happens in any, in any year. So I think each one of them can pat themselves on the back that they got it right.
Maybe they will. We'll see. We're going to find out. Okay. Here's another quote. Most of today's buyers are folks who have to move due to family or professional reasons. They could be expecting a new child or having their elderly parents or grown children move in with them and need the extra space. There could be a divorce or death that would precipitate a move. Also, remote workers who are still able to trade more expensive cities for less expensive ones are still on the hunt for homes. It seems to me, anecdotally, we're getting more people contact us that want to buy than to sell.
Yes.
This is completely anecdotal. Meaning people are reaching out to us saying, hey, I'm looking for an agent to buy a house, to buy a best property. I had a conversation with somebody today who wants to buy a home here. And it doesn't seem like there's any, like they're not balking at interest rates. They're just like, I'm going to buy a house.
Right. Yeah, like I said, I think buyers are in the market and they want to buy something, whatever that is, whether they're getting a loan or whether they're buying cash. They understand what the situation is, and they are ready and willing to buy. It's a matter of finding the right property.
Okay. All right. Okay. Now, here is the big chart. This is the cool chart. This is the forecast. Now, what you see in that original forecast, that was December of 2022, beginning of the year. These groups were all asked, where do you see home prices going? Okay. Mortgage Bankers Association said down 0.6%, Fannie Mae down 1.5%, Morgan Stanley down 4%, American Enterprise Institute 15 to 20%, Zillow 0.7%, Wells Fargo down 5.5%, Goldman Sachs down 5 to 10%. Home price expectations are down 2. We actually did a big video. We did 17 of these, and we got all their estimates. And there were 3 or 4 who said higher, and there were a couple who said less, and then all the rest were down, but the most was 20%. Nobody said more than 20%, right?
Right.
Okay. But now look at their forecast. None of them are predicting price declines for the whole year. The reason they aren't is because prices are already up this year. Mm-hmm. So prices would have to decline pretty far to get back to zero, which is why a couple of these are zero. Morgan Stanley, Mortgage Bankers Association are predicting some declines in the fall, which we get every year. And then you have Fannie Mae saying 3.9%. But what gets me is this American Enterprise Institute. I don't know who they are, but they went from down 15 to 20% to up 6%. And then Zillow's up 5%. That was a pretty big swing there. Right. CoreLogic's not on here, but CoreLogic was saying 6 to 8%, right? They had a pretty big, they were saying prices would appreciate. I think they were the most robust of all of them. Right. They just not on this chart because I just grabbed this chart off the internet.
Yeah. CoreLogic and Zillow were very bullish.
Yeah, they were super bullish, I thought. Okay, so where does this leave us? Because I think this is the sort of consensus now. Interest rates don't go up anymore, right? They're 7.12%. That's the going rate if you go on. And I recommend if you're looking at some other bank rate or some banana mortgage site or whatever, just go to Freddie Mac. Freddie Mac is literally, this is what they do. They sell the loans in the secondary market. They control by far Freddie, Fannie, and FHA are where most of the loans are being originated from banks backed by those entities, those government service agencies, okay? You should look at that data. That's the most accurate data, right? There are secondary lenders who are going through these other companies and these subprime mortgages. There are not many of them, but then those rates are higher. So you just can't go on those rates, even if you have really high credit. If you're looking at one of these subprime mortgages, then they have different criteria and the rates are much higher. But most people are not getting those rates. The rates we're seeing, matter of fact, right now you can do a 15-year fix with a average credit score. When I say average, like 680 to 720, for like 6.38%.
Wow.
For a 15-year fix, and that's just a Freddie.
Right.
So that's not completely unreasonable.
Right. And then remember, there are all kinds of other buy down options out there. So, for example, builders are doing the 3-2-1, where in the first year your mortgage rate is actually 3% lower than the going rate. In the second year, it's 2% lower. So let's say that you're getting a 7% mortgage, right? So in your first year, you get 3 points off. So in your first year, it's 4%. In your second year, it's 2 points off, so now it's 5%. In your third year, you get 1 point off, and that's 6%. And then in the fourth year, it adjusts to 7%, and then it stays there at 7%.
But it's not an adjustable loan.
No.
It's a fixed loan at 7%.
Right.
Now, here's the thought, and this is, sort of a great way to think about this. If you're betting that interest rates are going to drop, this is a great product, because the worst case scenario is you go back to 7%. Interest rates go to 10%. The highest you go to is 7 and it stops. Right. But what you're banking on is interest rates go down, to 5.5 or 5 or 4. And then when you get to that point where it goes to 7, or at some point in there, you just refi the thing. Even if it goes to 5.5 and you're at 6, you go, you know what? I'm just going to get the 5.5 and lock that in and just forget going to 7 next year, because maybe it goes back up or whatever.
Right. So it is a good loan product, and builders are very fond of doing that particular loan product, particularly because, remember, a lot of builders have either their own mortgage company or they have an affiliation with the mortgage company where they share in revenue. So they have that flexibility to do that.
Okay, here's my concern. Interest rates, all interest rates did by going up to 7% was stop home prices from continuing to go up 18% a year, right? There's cash building up on the sidelines. My concern is that, at some point in the future, the Fed starts dropping rates back to a reasonable level to allow economic activity and money to flow in the system. That mortgage rates drop again, and all this cash on the sideline starts coming back into the market. And we have this imbalance again where we don't have enough listings, or it turns into a frenzy again where home prices start kind of rocking again.
Okay, so let me give you a different scenario.
Okay, give me a different scenario.
So you're right, cash is building up on the sidelines. So with cash building up on the sidelines, maybe the interest rates don't matter anymore, because now you were going to put 20% down, but you've been sitting on your cash for the last couple years, and you've accumulated cash. So now instead of putting 20% down, now you're putting 30% down. So now you don't need a lower rate because you have effectively lowered your payment by putting more down.
The other thing too is, I'm hearing a lot of people talk about how much money they've been putting in these money market funds that pay 4.5 to 5.1% or something like that. Remember, that's not permanent, right? Is those funds will change because they're backed by instruments that they're paying some rate. So what'll happen is at some point they won't be able to maintain that rate, right? They'll start dropping. And then people will say, hey, okay, my money's only making 2 or 3% now, I'm going to deploy it.
Right.
And then they'll say, maybe I'll just go into real estate or something else. Stock market's still pretty overbought, for PE ratios, and it's at, potentially all-time highs. And you can't really, so you have to figure out what to do with all this cash. Like, there's still a lot of cash out there. I think that's one of the things that is not looked at enough. Although inflation is been dropping, but there's still too much cash in the system, and I think this cash is going to start coming out at some point. They're going to put it in, it's going to go into some asset.
Right. I mean, look, people's cash is deployed. It's a matter of where it's deployed, right? So to your point, people's cash is deployed in money markets or something like that, or CDs or whatever. So people's money is being put to work because people are wise enough to understand that your money needs to work, right? But at some point, whatever their situation is, they're going to hit some sort of critical tolerance, right? So whether it's because their family's growing or shrinking or changing in some way, or they're relocating or whatever it is, and they need to purchase, and they're going to go ahead and purchase. And like I said, like you said, the money has been making money in money markets and what have you, and that's great. They've been saving money because they've got low interest rates on their mortgages, so they have excess cash, and that's great. And the interest rate, the going interest rate for mortgages will matter less. the more time passes, the more the going rate for mortgage interest rates matters less. It matters less because people are accustomed to it. It matters less because people have more money to put down. It matters less because lenders get more creative with loan programs and make loans more attractive. So there are all kinds of reasons why higher interest rates will matter less. Whether or not the Fed reduces interest rates substantially, I really question that, to be honest. I can't imagine the Fed reducing interest rates substantially. The soft landing is really nice, but I think it's very tentative. I think that inflation is just kind of sitting there waiting to pounce again. And I think that the Fed is aware of that. And I don't expect the Fed to drastically reduce interest rates.
I think you're exactly right. I think if you had predicted, like all these people predicted home price forecast, I think if we would have seen this at the beginning of the year, we would have disagreed with it. What do you think about that one? If we just seen everybody saying home prices would be up or, not down, do you think we would have said, hey, maybe they're being a little bit too optimistic?
Yeah, I mean, we expected home prices for this year to be flat. I mean, that was my expectation. I expected, point up, point down, whatever, but basically flat. That's what I expected. And in a lot of markets it has been. There are markets where it's still gone up, and there are markets where it's still declined. But I think for the most part, home prices haven't done anything dramatic, and then that's kind of what the expectation that I had at the start of the year.
Okay, last piece of data before we wrap up the video.
Okay.
I read this article. I don't have the thing. In Las Vegas, year to date, we have sold more luxury homes over $1 million, than any year ever. Mm-hmm. It's the number one. It's the highest year for most sales of homes $1 million or more.
Right, and I've said this in multiple videos. We have a brand new luxury market. Before we had a few luxury homes. Now we have an actual luxury market. It is in its infancy, and I acknowledge that, but we do have a luxury market. We have builders that are building spec luxury homes, which we have not had before. So when I say spec luxury homes, I mean homes that are $4 to $7, $8 million, and they're spec homes. So that's a new product for us. We have homes that are selling in the $20+ million range, which again, that's a new thing for us. So, that is why you're seeing that. This is a new thing for us. Now, a lot of that has to do with the pandemic and what happened in our neighbor, California. That's driven a lot of people from affluent areas in the Bay Area and in Southern California, where maybe they had a less luxurious home that was nevertheless expensive by Vegas standards, and they took that money and they came to Vegas and got something amazing. So part of that was the pandemic, part of that was taxation policy, right? So that happened in Southern California, it happened in Seattle with taxation policy, and that drove people here. So all of those things are reasons why we have this this blossoming luxury market.
And I want to point out, it's not based on price, it's actually based on the quality. Mm-hmm. If you don't believe me, go on Zillow or Realtor.com, go search Palo Alto, California, and put in $3 million and tell me what kind of houses you see. And then put in Las Vegas and put in $3 million and tell me if you notice a difference between a $3 million house in Palo Alto and a $3 million house in Las Vegas.
Right.
It's a substantial thing.
Absolutely.
Yeah.
So we do have quality homes. We have some really innovative builders. We have beautiful views, whether it's the mountains or the Strip or whatever. We have lots of really good reasons why people with a substantial amount of money to spend on homes choose to purchase homes in Las Vegas. So a lot of them are second homes. And that's another thing that's happening in Las Vegas. So we have a lot of second home purchasers. We used to have second home purchasers in the high rises, and now it's definitely spread out to the suburbs. We have a lot of second home purchasers in the suburbs.
Yeah.
Okay.
All right.
So what did you think? Was it interesting? Was it entertaining? Did we make you laugh?
Or cry.
Tell us what you thought. Give us your thoughts on the market. Tell us where you're watching from. You don't have to agree with us. We welcome all opinions. Remember to like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.